A former mail carrier from Ohio who had retired opened his letterbox toward the end of February 2026 and found a notice from the Internal Revenue Service. He was 71 years old, had finished 30 years of government work, and he had done everything properly, or at minimum, that was his understanding. He had taken his required minimum distribution in December, he had paid his Medicare premiums on time, and he had filed his tax returns every single year without a single miss. The notice stated he owed $947 in underpayment penalties, not taxes he had forgotten, not fraud, not an audit, a penalty for not sending enough of his taxes at the proper times throughout the year. And the part that should make you furious is that not one person had ever told him this rule was in place. Now, multiply that situation by 4.7 million. That is the number of penalty notices the Internal Revenue Service is expected to send to retirees, and soon-to-be retirees this tax season. 4.7 million Americans who paid their taxes in full, who filed on time, who did everything their accountant or tax software told them to do, and they are still getting hit with a penalty that averages several hundred per household, and in some cases significantly more than that. The mistake that mail carrier made and the mistake millions of retirees are making at this moment is completely fixable. It takes one form, one phone call, or one afternoon with your December required minimum distribution. And once you understand how the system actually functions, you will never pay this penalty again. Here is what occurred, and here is exactly how you ensure it never happens to you. This video exists for educational purposes only and does not represent tax or financial advice. Consult a licensed professional before making any decisions regarding your personal situation. Here is the core problem, and I want you to understand it before we look at the stories because once you grasp the mechanism, everything else snaps into place. The American tax system operates on a pay-as-you-go basis. The Internal Revenue Service does not want to hold off until April 15th to collect what you owe. They want it throughout the year in roughly equal installments as you earn or receive income. When you had a steady job, your employer handled this seamlessly. Every 2 weeks, they pulled money from your paycheck and sent it to the agency for you. You never had to think about it. You never had to fill out a document. You never had to mail a check to the government in the middle of July. Then you retired, the paycheck stopped, the automatic withholding stopped, and now you have a pension or Social Security or required minimum distributions from your individual retirement account, or some mixture of all three. And not one of those income sources automatically withholds the right amount of federal tax unless you specifically instruct them to. The Internal Revenue Service did not send you a letter breaking down this shift. Your former employer did not give you a heads up. Your tax software filed your return correctly and then moved on. And so millions of retirees get to the end of the year, owe taxes on income they received all year long, write one check in April, and then get slapped with an underpayment penalty on top of it because the agency wanted that money spread across the calendar, not delivered in one lump at the finish. The penalty itself is figured under Internal Revenue Code Section 654, and the rate is not small. The underpayment penalty rate for 2026 is tied to the federal short-term interest rate plus 3 percentage points, which puts it at roughly 8% annualized on whatever amount was underpaid for however long it was underpaid on a $15,000 underpayment, which is not an unusual figure for a retiree with a pension, a Social Security benefit, and a required minimum distribution all coming in throughout the year. The penalty can easily top $900. On a $30,000 underpayment, the penalty can go beyond $1,800. And I want you to sit with that for a second because this is not a penalty for fraud. This is not a penalty for hiding income or submitting late. This is a penalty for paying the right amount of tax at the wrong moment. That difference matters tremendously because it means the fix is entirely in your hands, and the Internal Revenue Service itself has written several instruments into the tax code to let you wipe out this penalty completely before it ever shows up on your return. Scenario 1. Carol is 68 years old. She is a retired public school teacher from Illinois with a state pension that gives her $42,000 per year. Her husband died 2 years ago and she now files as a single taxpayer. She also collects Social Security retirement benefits of $22,800 per year. and her accountant helped her merge her late husband's individual retirement account into her own, which now carries a balance of $280,000. When Carol hits age 73, I am pushing the clock ahead to reveal the full picture. She will be required to withdraw a required minimum distribution of approximately $12,000 from that account. Altogether, her gross income for the year will land somewhere around $63,000 once you factor in the provisional income formula that decides how much of her Social Security benefit gets taxed. Her federal tax bill works out to roughly $7,400. Carol had always just mailed a check in April because that is what her accountant told her to do. In April of 2026, she mailed that check and then got a second notice for $480 in underpayment penalties. She called her accountant, who said sorry and walked her through the rule for the first time. Not a single person had mentioned it to her in the 4 years since she retired. $480 gone for doing exactly what her advisor had recommended. Here is what Carol could have done instead, and I will go through the exact mechanics in the action checklist in a few minutes. But the short answer is this. If Carol had submitted a Form W-4V, that is the voluntary withholding request to the Social Security Administration, she could have asked them to withhold 10, 12, 22, or 22% of each monthly benefit payment and forward it directly to the Internal Revenue Service on her behalf. That withholding would have addressed a significant chunk of her annual tax bill in a spread-out ongoing fashion throughout the calendar year. She could have also contacted her Illinois pension administrator and submitted a withholding election to pull taxes from each pension disbursement. Most public pension systems have this available, and most retirees never ask about it. Handle both of those actions, and Carol's underpayment penalty would have been zero. Same income, same tax bill, different payment timeline, same input, different output. One costs her $480, the other costs her nothing. Scenario 2. This one features a man I will call Robert. Robert is 74 years old, a retired firefighter from Texas, and he is one of the people you would think is best protected from this problem because Texas charges no state income tax. And because Robert has been diligently submitting quarterly estimated payments every year since he retired, his pension from the city where he worked for 28 years pays $61,000 per year. He is not yet drawing Social Security because of the government pension offset, but that is a different conversation. Robert also has a rollover individual retirement account with a balance of $450,000, and he has been withdrawing required minimum distributions for 2 years. His required minimum distribution for 2025 was roughly $18,000, up from $14,000 the year before because his account balance had increased. His federal taxable income after the standard deduction for a single filer over 65, which in 2026 is approximately $16,350, came to roughly $61,650. His federal tax bill was about $9,200. Robert had been estimating his quarterly payments based on the previous year's income, which was lower because his required minimum distribution amount had not yet climbed. His quarterly payments added up to $7,200. That created a shortfall of $2,000 against his true obligation. The penalty on that underpayment, calculated quarter by quarter at the relevant rate, came to roughly $500. Robert cannot figure out where things broke down. He made his payments on time. He did everything he was expected to do. The reality is that his income jumped when his required minimum distributions increased, and he never circled back to adjust his quarterly payments to match. That is one of the most common pitfalls I encounter, and I am going to come back to the fix in the checklist. Scenario 3, this one is the unexpected one. So listen closely because this is the scenario that surprised even people who think they have this completely figured out. Patricia is 67 years old. She is a retired hospital executive from Minnesota. She has a pension of $48,000 per year, a Social Security benefit of $31,200 per year, and she is not yet required to withdraw required minimum distributions because she does not turn 73 until 2030. Patricia is remarkably meticulous. She sends quarterly estimated payments every single year. She uses tax software to calculate her estimated figures, In 2025, she paid $3,100 per quarter, $12,400 in total across all four installments. Her actual federal tax bill for the year came to $12,100. She overpaid by $300. No shortfall, no problem, right? But here's where the snare closes. In the third quarter of 2025, Patricia had a health emergency. She got behind on paperwork. She missed her September 15th estimated payment entirely. She caught up in October and sent in a double installment, $6,200 to make herself whole for the year. But here is what Patricia did not know. The Internal Revenue Service calculates the underpayment penalty quarter by quarter on its own, and it does not care that you overpaid in a different quarter to make up for it. You cannot fix a missed quarterly payment by doubling the following one. The penalty had already built up on the September 15th underpayment from the second that deadline passed until the day her October payment landed. Even though Patricia sent in more than her total tax bill for the entire year, she still owed an underpayment penalty of approximately $42 because one quarterly installment showed up late. $42 is not the end of the world, but it is $42 she never should have paid. And more importantly, it showed Patricia just how rigid and merciless this penalty system truly is. The agency does not reach out to tell you a deadline is coming. It does not send a caution letter, it simply calculates and bills, and it does not care that you are lying in a hospital bed. Scenario 4. Now, here is the method that changes the entire game for retirees who withdraw required minimum distributions. And this is the play that the sharpest retirement tax strategists use and that virtually nobody in popular financial media brings up. Meet Gerald. Gerald is 76 years old, a retired government worker from Pennsylvania. He has a pension of $38,000 per year, a Social Security benefit of $26,400 per year, and a required minimum distribution from his individual retirement account of $14,600 per year. His estimated total federal tax bill for 2025 is roughly $10,800. Gerald does not want to deal with quarterly estimated payments. He finds the system confusing. He is nervous about slipping up like Patricia did. He wants a clean and simple answer. Can Gerald avoid the underpayment penalty without ever sending a quarterly estimated check? The answer is yes. And the tool is one of the most powerful and least utilized instruments in the retirement tax arsenal. Gerald tells his individual retirement account custodian to withhold a precise dollar amount from his required minimum distribution as federal tax withholding. He holds off until December, keeps his money growing in his account all year long, and then in mid-December, he takes his full required minimum distribution and tells his custodian to withhold $10,800, which is his full estimated federal tax bill for the year. That money goes straight to the Internal Revenue Service. Now here's the brilliant part, and this is the rule that makes this whole method work. Under the tax code, federal income tax that is withheld at the source, meaning withheld from an actual disbursement, not mailed as a quarterly estimated check, is treated as if it were paid evenly throughout the entire year, no matter when it was actually withheld. The law does not say December withholding applies only to December. It says withholding applies as if it happened uniformly across all 4 quarters. So, if Gerald withholds $10,800 in December, the Internal Revenue Service treats that as if he had paid $700 on April 15th, $1,700 on June 15th, $1,700 on September 15th, and $1,700 on January 15th of the next year. All 4 quarterly deadlines completely covered with a single instruction made in December. Gerald gets to keep all of his money growing in his account from January through mid-December. He pays 0 underpayment penalty. He writes 0 quarterly checks. He makes 0 phone calls to the agency. He just tells his custodian what to do in November, and everything is taken care of. Same tax bill as Carol. Same income profile as Robert. 0 penalty. That is not a trick. That is the law. And the Internal Revenue Service is not going to call you to spell it out, but that is exactly what is being laid out for you right now. Now, here is where it gets critical. And this is the section of the video I want you to save or write down because most people, including frankly many tax preparers who do not specialize in retirement income, do not have a clear view of all 3 shields that exist against the underpayment penalty. You only need one of them to kick in to be completely protected. The first shield is the current year safe harbor. Under Internal Revenue Code Section 6065-4, you are entirely penalty-free if the total of your withholding and your estimated payments equals at least 90% of your current year actual tax bill. That means if your tax liability this year ends up being $15,000 and you paid at least $13,500 throughout the year in a combination of withholding and quarterly payments, you owe no penalty. The second shield is the prior year safe harbor, and this one is easier to apply because you already know exactly what your prior year tax was. It is on last year's Form 1040, line 24. If your total withholding and estimated payments this year equal 100% of your prior year tax bill, you owe no penalty, regardless of how much more you owe this year. For higher income taxpayers, particularly those with a prior year adjusted gross income above $150,000, the prior year safe harbor increases to 110% instead of 100%. So, if your adjusted gross income last year was $200,000 and your tax bill was $22,000, you need to pay at least $24,200 this year, 110% of last year's liability, to use the prior year safe harbor. These two safe harbors combined mean that if you stay connected to your prior year return, you will almost never face an underpayment penalty, even if your income rises significantly. The third shield is the one virtually nobody knows about, Form 2210, the underpayment of estimated tax by individuals and fiduciaries. This form does two things. First, it allows you to annualize your income, meaning the penalty calculation is done based on when your income was actually received, not spread evenly across 4 quarters as if you earned it at a steady pace. This is critical if you took a large required minimum distribution or Roth conversion in the 4th quarter, if you sold an investment property in November, or if any of your income was heavily front or backloaded during the year. Using the annualization method in Part 2 of Form 2210 will often reduce or wipe out a penalty that would otherwise show up automatically on your return. Second, Form 2210 includes a specific waiver provision for retirees. If you are 62 or older and you retired or became disabled during the tax year or the prior tax year, and you can show that the underpayment was due to reasonable cause and not willful neglect, the agency can waive the penalty completely. This is a limited waiver. It does not cover every scenario and it demands supporting records, but it is real. It is in the law, and millions of newly retired Americans who would be eligible for it have never heard it brought up by their tax preparer. Here is your action checklist, and I am going to give you 10 specific things you can do right now. 1. Pull up your most recent Form 1040 and find your total tax on line 24. Write that figure down. That is your starting point. That is what you need to equal this year at a minimum to qualify for the prior year's safe harbor. 2. If you collect Social Security benefits, visit ssa.gov or dial 1-800-772-1213 and ask for Form W4V, which is the voluntary withholding request. Select a withholding rate of 10, 12, 22, or 22%. Choose whichever percentage, when multiplied by your annual Social Security benefit, gets closest to covering your portion of the estimated tax bill. This adjustment usually takes 6 to 8 weeks to activate, so do not put it off until December to start this process. 3. Reach out to your pension administrator, whether that is your state's retirement system, a previous private employer, or if you are a federal employee, the Office of Personnel Management, and request to submit a withholding election on your monthly pension checks. Almost every pension system allows this. Ask specifically for the withholding election form and confirm your election takes effect before the upcoming calendar year. 4. If you are already withdrawing required minimum distributions from an individual retirement account and you want to use the year-end withholding method I outlined in Gerald's scenario, reach out to your individual retirement account custodian no later than mid-November and let them know in writing that you intend to take your required minimum distribution in December and that you want to withhold a specific dollar amount for federal taxes. Figure that dollar amount against your prior year safe harbor number, so you know exactly how much to have withheld. 5. If you submit quarterly estimated payments, enter all 4 deadlines in your calendar right now. April 15th, June 15th, September 15th, and January 15th of the following year. Do not try to make up for a missed payment by doubling the next one. The penalty kicks in the instant a quarterly deadline passes with an underpayment, and sending money afterward does not erase what has already built up. 6. If your income went up this year compared to last year because of a bigger required minimum distribution, a Roth conversion, a pension cost of living bump, a part-time job, or unanticipated investment distributions, redo your quarterly payment calculations right away. Use your prior year tax bill as the absolute baseline and raise it if you know this year's income will be noticeably higher. 7. If you had uneven income this year, a big lump sum distribution in the fourth quarter, a property sale in November, an inherited individual retirement account distribution late in the year, tell your tax preparer to fill out Form 2210 and apply the annualization method in Part 2 when they file your return. In many cases, annualizing your income based on the actual receipt timeline will bring your calculated penalty down to zero or close to zero, even if your total annual income was considerably higher than last year. 8. If you reach 62 or older and you retired or became disabled in 2025 or 2024, directly ask your tax preparer about the reasonable cause waiver that is offered on Form 2210. Point them to the form instructions which outline the waiver for retired and disabled individuals. Do not expect your preparer to mention this on their own. Many will not. 9. Before you decide how much to withhold from a required minimum distribution, or how large a distribution to take in any given year, verify whether the additional income would push your modified adjusted gross income above the income-related monthly adjustment amount thresholds for Medicare Part B and Part D. As of 2026, those surcharge levels begin when your income as a single filer crosses approximately $17,000, and they can add several hundred to several thousand per year to your Medicare expenses. A distribution strategy that rescues you from a $900 underpayment penalty is not worthwhile if it triggers $1 in $800 in Medicare surcharges. Calculate both figures. 10. Do not count on your tax software to warn you about the underpayment penalty before it strikes. Tax software figures and reports the penalty at filing time after it is already too late to stop it. Set a recurring reminder in your phone or calendar for mid-October of every year. Use that reminder to check your year-to-date income from every source. Project your full-year tax bill and measure that against what has already been withheld or sent in quarterly installments. That single annual checkup done in October, when you still have time to make corrections, is worth more than any individual form or phone call. Let me attach one last dollar figure to this so the reality is completely clear. The Internal Revenue Service is forecasting 4.7 million penalty notices to retirees in this filing cycle. The average penalty in recent years has landed between $400 and $800 per household. At the lower end, that is approximately $1.9 billion in penalties taken from American retirees who did absolutely nothing wrong except pay the right amount of taxes at the wrong point in time. $1.9 billion pulled from people who worked 30 and 40 years, contributed to this system their entire working lives, and who are now being penalized for not grasping a rule that no government body ever sat down and walked them through. Many of those households have adjusted gross incomes below $50,000 per year. This is not a tax on the wealthy. This is a penalty landing disproportionately on retired teachers, retired firefighters, retired mail carriers, retired nurses, people who have minimal space in their budgets to handle surprise fees they never deserved. You are not going to be one of those 4.7 million. The safe harbor rules are in Internal Revenue Code Section 6054. The withholding treated as evenly distributed rule has been on the books for decades. Form 2210 has existed in essentially its current structure for a long time. Form W4V is available on the Social Security Administration's website right now, ready for you to download it. These instruments are in the tax code precisely because Congress understood that the shift into retirement produces withholding gaps, and they decided to give retirees a collection of legal tools to close those gaps without penalty. Your county property records office has your name and address. They have never once sent you a letter describing those instruments. The Internal Revenue Service has never reached out to describe them either. That is exactly why this information is so vital right at this moment. If this video was helpful to you, press the like button right now. It takes 1 second, and it helps this video find more retirees who need to hear it. If you have not subscribed yet, press subscribe and activate the bell so you do not miss the next one. If you know a retiree who has been filing responsibly every year without ever establishing, withholding on their Social Security payment or their pension disbursement, and there are millions of them positioned one missed quarterly deadline away from a penalty notice, forward them this video today. It could spare them several hundred this very tax season. And before you go, I want to ask you one thing. Have you ever gotten an underpayment penalty notice from the Internal Revenue Service? Drop a comment below and tell me what year it occurred and how much it cost you. I read every single one, and the most frequently asked questions turn into future videos. I will see you in the next one.